All right, we're running a little bit late, but we do try to come in under an hour and 15 minutes, and I can certainly make that. I'm going to go ahead and top things off by a little bit of a switch and bait here, I think. I started off tonight thinking that I was going to go for Pepsi. One of the things I would do like to point out, and we'll use it to reinforce the point that both Ken and Si made a few minutes ago, every week we literally go through the value line release on Monday morning and look for companies with fairly attractive low total return forecasts, because again, we think that's probably one of the better second opinions out there in general for a stock study. And you can see we've got the presidential candidate that ran from the rent is just too damn high party. I used it as kind of a frame to talk about PE ratios, and just kind of a little bit of a theory that a lot of people have been talking about this new norm, and I think this is one look at a potential impact of a new norm. Those of you out there that follow our forum know that Dan Hess, our guy from California, has done an awful lot in the area of talking about the new norm, and I think this is one of the areas where we actually see data and information that support it. For most of the first decade of the new century, you know, PEs were up in that 17 to 18 range, and of course the Great Recession hit and really put quite a kink in the situation there. But what I think a lot of people are speculating or theorizing that PE ratios are not going to return to those higher levels, that we're not looking at a trough situation, we're looking at a step change situation. So this is not just a trough where everything goes back to normal. This is potentially a situation where we've seen literally a step change in expectations. And again, Ken does an awful lot in the area of inflation, the impact of inflation on our expectations. And if you begin to get into a point where you believe that inflation is imminent, or again, in the intermediate or longer term perspective or scenario, you pretty much have to be in a situation where you reduce your PE ratios, your forward PE ratios, your forecast PE ratios during your stock studies. And in fact, in looking at that chart, what we find in looking over all 2,700 companies that we track, kind of a general downward trend in the PE ratio of about, right now, about 1% per year. So it's just something to kind of think about. And framing, we talked about Professor Schiller's efforts in the area of PE ratios. Pepsi actually came up pretty good in that our weekly report. And again, we post that. Those of you that use the Manifest forum, we post it there first. Those of you that are not Manifest people, we actually do post it on our Facebook page, and that's completely free and open to the public. So in the case of Pepsi, here's a look at the value line report, and this is the number that Si was referring to and Ken made some reference to. Again, we don't pay so much attention to the average as to the low here, and consider that to be a kind of a second opinion that merits some attention. And Pepsi is another one of those stocks that has that we talked about getting stuck in the mud last month, and it certainly is one of those where the stock price had a pretty good run in 2009, jumping up from the low 40s up to the mid 60s, but it's been kind of dormant since then and kind of backed off a little bit, although as we discovered as we looked at it a little bit closer tonight, it's actually run up pretty strong in the last couple of months. But again, these conditions, relatively high forecast return here, that should resemble the results of any stock study that you do, and a relatively lengthy flat spot in the stock price is something that's relatively attractive to us as we do our studies. Here's a closer look at the top line and bottom line visual analysis style for the company. And again, we're definitely seeing some impact from the Great Recession here. You can see the slight bump down in sales, a little bit of a bump down in earnings at that same time frame. Price obviously follows earnings, so we saw that along with some price recovery as earnings got back on their long-term trend. It is a company that can grow in that 10 to 11% range. Pretty interesting range of products, and 10 to 11% growth is not an unreasonable place to be. One of the things that we do see happening with companies like Pepsi, and there's some pressures the recessionary conditions in Europe and a few other places where margins have been a little bit compromised of late, but a little bit of a shuffle in product mix. But most of the experts feel that the company can maintain a net margin, net margin, somewhere in that 11 to 12% range going forward, after a little bit of a bumpiness there and kind of a reset following the Great Depression. But I'm going to actually switch gears and go with a company tonight that I just want to be a little bit more opportunistic. This is a company, Logitech, that we have talked about in some of our events in the past. They make an awful lot of computer peripherals, and they've really been hammered. You can see that the prices come down substantially from the 17 range down to the 13 to 14 range in recent weeks. And again, we're looking at a 3-year technical analysis chart on the company where the relative strength index is now down below 30, and this is what we think of as a potentially oversold condition, where it's actually a case where the pendulum has kind of gone too far the other way, and it's a possibly kind of like a company at a garage sale. I'm going to show you in a second where we encountered this tonight, as we're just kind of kicking things around a little bit. But oops. Did we lose me? Ken, are you still there?
Mark, we can still hear you. Go on.
Okay, it just sounded like everybody left. What I'd like to do now is show you where we came up with this tonight. And I'm going to switch over to the website called stockcharts.com. One of the things I like to do from time to time, again, don't take this the wrong way, again, 80 to 90% of what we do isn't still on the fundamental side, but every once in a while we like to look at the charts. And again, we're gonna have some sessions that actually explore this in greater detail. It's really no more complicated than trying to keep track of the rhinos, the institutional investors, what direction they're headed and what speed they're running as a group. And this is a group of companies that you can see here that came up on a predefined scan, and these are oversold with an improving relative strength. You can see that we're looking at a number of markets there, but it's at stockcharts.com. If you're not familiar with stockcharts.com, I would encourage you to take a look. It's free, and you can actually spend some time, and I would encourage you to take a look at you can go into the chart school and look at relative strength. And again, I'll often just kind of leaf down the list, scan the list, and look for companies. Hughes Bank of America is showing up as potentially oversold. Here's Logitech here. It shows up down here towards the bottom. New York Community Bank also, but Logitech shows up, and that's where we basically picked up on it. And again, this is what it looks like over the longer term chart. So we'll jump over to Manifest Investing now and take a look at the actual fundamental forecasts and see why we find it attractive. And again, this is just kind of a quick move on the run. It's got an excellent quality rating with a projected annual return in the 18% range. It does reflect the current price of just under $14. We're talking about a company that grows in the roughly 8% range with profit margins in the 8 to 9% range. They did recently have some nasty news, and the nasty news we'll take a look at here in a second. It's something we would take a little bit closer look at, but it didn't seem too disastrous. It's a company that has a high teens projected return based on these conditions, PE ratio that's not too exorbitant. But here was their nasty news. This is also something that we have conditioned or counseled people to take a closer look at. I'm going to go to Logitech, and again, keeping track of the rhinos, keeping track of how the analysts are behaving on the company. We're going to actually take a look at analyst estimates for Logitech, and it'll explain that horrific price drop that you just saw. We would actually come back and embed these numbers, and they're not dramatically different, into the long-term trend for the company. But what happened within the last week or so, and again, I didn't go and read the news in any great depth, but you can see it right here. The estimates for what would be 2011, fiscal year ending March, 2012, their expectations for earnings went from $1.21 to $1. And again, I would theorize that this is very much in concert with the stuff that happened with Dolby, a couple of the other computer manufacturers that are not named Apple, and basically just an admission that computer sales might slow down a little bit, but they're so much better than they were. And again, you have to think in terms of the long-term perspective anyhow. So again, not a catastrophic drop, probably probably an over-accounting for conditions. They tend to panic. And again, so my selection, where I was leaning towards Pepsi, will instead be Logitech for my selection this month.